Hi, it's Jim Yant from Golden Years Advisors, the home of the Kairos formula. And it's Friday, July 14th, and it's the first day of the second quarter of the new earnings season. So all eyes are watching that. But we had two great pieces of news this week, which has caused the markets to rally and to rally to 52-week highs. The S&P 500 broke 4,500. It's still got a long way to go to get all the way back to its all-time highs, but it's fighting and clawing to make that recovery. The good news that we had was first, the producer price index, the PPI. During the COVID lockdown, the blue line is the PPI for durable goods. It spiked up to an 18% year over year price increases because we all were locked up in our rooms and we were buying stuff online and getting it shipped at home. We've seen it fall dramatically, as you can see that blue line, so that now on a year over year basis, it's actually negative 4.4% versus last year. And if we focus in on the green line, that's the services line from a production perspective. It similarly had spiked and is falling and is now down to a reasonable 2.3% rate. So that's the producer side of inflation. This is CPI, the consumer price index, the consumer side of inflation. And if we think back just last summer, CPI, when it came to a headline number, was at 9.1%. That's the red line in the chart. And you can see with the June numbers that were just announced, CPI now from a headline perspective down to a 3%. A lot of that is because of the fall and decline of oil prices, food, and other things. The blue line is the stickier core number where they subtract out the volatile things, oil and food, and it is coming down, but it's still above target. Target's 2, and it's sitting at 4.8, which is why later this month, the Federal Reserve will meet again, and they will undoubtedly raise rates again. They promised us 2 more rates increases before the end of the year, quarter point each. The market thinks they're only going to do 1. The market, based upon how the yield curve is looking, says they'll do 1 and that's it. They'll hold it there for the rest of the year, but they're not going to do any more for it. Well, with inflation coming down, that's the good news that, well, the Fed probably doesn't have to do as much. They can just sit and wait and see how things develop, which if that's the case, maybe the worst is behind us, which is one of the key questions in front of everyone. But the market is clawing and trying to go forward. So that's what just happened this week, big news. And when we look at CPI, the reason why we're more optimistic going forward is that stickier core number. We've told you all along, it's because of the way the statistic calculates what's called shelter. And shelter has 2 parts. The top chart is when they poll people, because that's how they get this data, and they say, have you rented your home? If so, how much are you renting it for? And so it's what's called the rent of a primary residence. The second chart down below, it's more like a hypothetical. They literally call people and say, well, have you rented your home? No. Well, what would you rent it for? So it's called owner equivalent rent. Each green bar is the month-by-month numbers, but what you can see is the good news. The blue line is that moving average, that average of the last 12 months, and you see both of them have peaked. So it kept climbing and climbing. For instance, last month's core number, over half of it was all rent related. So if it's now coming down, that's even more optimism as we look forward. The Fed probably doesn't have to be as tough, we hope. So that's where we're at now. But if we try to look forward, the best way we know how to communicate what's happening forward when it comes to the economy and profits is we use our friends, City National Rockdale, CNR, their speedometers. And they come out every month. There's 20 different indicators. Green means good, or the economy is expanding. You'll notice on the chart, there is no green. But what there is a ton of yellow, 12 to be in fact, and yellow just means neutral. It's that flat forward progress, which is what kind of our base case has been, that we continue to decelerate to like a flat point. 12 are in yellow, and 8. A month before there was 7, so we added one more red, which means we're decelerating, slowing down. And as the reds become the majority, we're in recession and things like that. Now, the changes from last month to this month, there's 4. One thing got worse. It went from yellow to red, and it's actually right over this shoulder. And you can read it say equity market valuation. It was a yellow neutral, so on the high end, but you'll see it just tipped over, and now it's into the red, namely because the market has risen so much and the corresponding profits haven't grown as fast. So one of 2 things happen in that case. Markets are anticipating, so they'll go up with the expectation that profits are coming. So if profits rise up, yay, or the market was ahead of itself. They were hoping for profits to rise in the future, but they really aren't. So then the market will have to correct back. Well, obviously, investors don't want that second thing to happen. They're hoping for profits to rise. More on that in a second. But that's the only thing that turned from yellow to red in the past month. The other 3 things are actually improvements. In the upper left corner, monetary policy, it was in the red, but it tipped a bit better, and it's because we're at the end of the rate increases, right? We have 1 this month, and if the Fed's correct, maybe there's 1 more. The market thinks it's 1 and done, but we should be at the end and not at the beginning of tougher interest rates in front of us. Next, when it comes to improvements, the second line down, 1 over, housing mortgages. Housing has been in a recession, and manufacturing with those goods, you saw the PPI, the producers' prices of goods have fallen. So those 2 parts of the economy have been in a recession, but housing this past month finally had some gains after over 14 months of falling volumes and falling sales. So that was another improvement. And we had one other. Over my other shoulder, geopolitical risks. After our recent visit to China with the Secretary of State Blinken, a little bit of chilling, a little bit of calming down in our China-US, who's the superpower of the day type conflicts that have been going on. So that's the forward look. Where all eyes are going to be is on the bottom row, second from the bottom row, dead middle. It's yellow. It says corporate profits. I told you today was day 1 of the new reporting cycle. The consensus forecast is that second quarter, which is behind us, it's historical. It's not what's about to happen, it's what happened. That second quarter profits will fall year over year about 8%. And today we had the banks announce, and they did better than expected. So that's good. Good day 1. But next week, we're going to see some big companies that the market loves to watch: Tesla, Netflix, more banks, Morgan Stanley, etc. And then we'll see the tech companies come in. If this second quarter is like the first quarter, we beat the forecast. It was supposed to be a 7% loss. It ended up being only a 2% decline in profits. Right now, some of the more optimistic forecasters on the street are saying we'll come in at maybe -4% of a year-over-year decline in profits. And if you look at the consensus forecast going forward at this juncture, for third quarter, it's flat. It's no loss. And then in fourth quarter, it'd be an increase, which is why the market is trying to claw its way forward. But we all know there's a lot of things that we're worried about. So we got our eye on them. In fact, next week, we're going to do another video. We're going to dive in on profits. We want to give you an update on what we call our worry list, the things we're watching, and also an update because things are getting better. You saw more good things happening than bad things on these speedometers. Is several of our forecasters are revising their year-end as well as 2024 forecast, and we want to share that with you. So we hope you're having a great summer, and we'll keep our eye on the markets. Take care.